Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we are diving deep into the mind of, well, arguably the greatest investor of all time, Warren Buffett. But look, this isn't just going to be about stock picks or a bunch of financial jargon. We're actually going beyond the myth of the Oracle of Omaha to really get at the fundamental principles that built his entire empire. And we're using Todd Finkle's fantastic biography as our guide here to deconstruct the whole philosophy. It's this amazing blend of business smarts, psychological discipline, and, frankly, life wisdom that made him a legend.
You know, to really get inside Buffett's head, you have to start right here with how he thinks about failure. I mean, just think about that quote for a second. He's comparing investing to the absolute peak of baseball success, hitting .400. And his main takeaway is that even that guy failed most of the time. Now, this isn't him being negative. It's him being profoundly realistic. It's all about temperament. It's knowing you don't have to swing at every single pitch. You can just wait and wait for that perfect one right in your sweet spot. That one idea, that patience and discipline are everything, is the foundation for all the rest. Okay, so let's get into it.
So here's our roadmap for this journey. First, we'll look at the Oracle's origins, then the all-important mentors who shaped him. After that, we'll get into Buffett's investing secret sauce. Then a really crucial one, mastering the investor's mind. And we'll wrap it all up with a look at his legacy beyond wealth. Okay, part one, the Oracle's origins. It's just impossible to understand the investor if you don't first understand the kid from Omaha, Nebraska, and the values that shaped him way before he ever bought a single share of stock. You see, this timeline, it's not just a list of dates, it's a story about compounding ambition. I mean, growing up during the Depression, that wasn't just some background detail. It was a hardcore lesson in risk, in value, and the importance of every single dollar. His ventures in grade school were like his own personal business lab. He was selling gum, coke, delivering papers, but he was always thinking bigger. He didn't just spend the money. He tracked every penny and reinvested his profits, buying pinball machines to put in local barbershops. He was learning about capital allocation before he even knew what the term meant. By high school, it was so obvious that his yearbook caption wasn't a joke. It was basically a fact. And those early partnerships, that was him taking everything he learned, his own money, and the trust of his friends and family, and starting the work that would one day become Berkshire Hathaway. Part two, the mentors who shaped him. You know, as driven as he was, Buffett's genius was just magnified by his ability to learn from others. And two men in particular really became the intellectual pillars for his entire career. Okay, this slide right here is probably one of the most important for understanding how Buffett evolved. First, you've got his professor, Benjamin Graham, the literal father of value investing. Graham taught him this quantitative, almost statistical approach. Buffett called it this cigar butt strategy. Picture it. You're walking down the street, you see this soggy, nasty cigar butt on the ground, but it's got one free puff left in it. You pick it up, take the puff, and toss it. It's gross, it's cheap, but hey, it's a free puff. You're buying mediocre companies at rock-bottom prices. And then comes Charlie Munger. Munger completely changed the game. He basically told Buffett, forget the cigar butts. It is so much better to buy a wonderful company at a fair price than a fair company at a wonderful price. Munger is the one who pushed him to focus on the quality of the business, the brand, the competitive advantage, the long-term future. And that shift from Graham's numbers to Munger's quality, that was the single biggest leap his philosophy ever took. So, part three, Buffett's investing secret sauce. What happens when you combine Graham's ice-cool discipline with Munger's wisdom about quality? Well, you get the core philosophy that has been the engine behind Berkshire Hathaway for more than half a century. So, if you only learn one thing from Buffett, please make it this one: margin of safety. This is the absolute bedrock, the principle he got straight from Ben Graham. And it's not just about finding a bargain. It's a way of thinking that forces you to admit that the future is uncertain and that you can be wrong. Think about it like this. An engineer builds a bridge that can hold 30,000 pounds, but the law only allows 10,000-pound trucks on it. That 20,000-pound gap, that is the margin of safety. For Buffett, it means you figure out what a business is really worth, and then you insist on buying it for way, way less. That discount is your protection. It's your buffer against a recession, a bad CEO, or just you making a dumb mistake in your analysis. Now, on top of that foundation of safety, he uses this deceptively simple four-step checklist. First, can I understand the business? This is his famous circle of competence. He invests in stuff like insurance and Coca-Cola because he gets how they make money. It's exactly why he stayed away from tech stocks during the dot-com bubble. Second, does it have favorable long-term prospects? He's looking for companies with a durable competitive advantage, what he calls an economic moat, something that protects it from the competition. Third, is the management competent and trustworthy? He wants leaders who are not just good at their jobs, but who have integrity. And finally, number 4, is the price rational? This brings it all right back to that margin of safety. Only if an investment gets a yes on all 4 of these does he even think about writing a check. Okay, part 4, mastering the investor's mind. And what's so fascinating here is that after all that business analysis, all those numbers, Buffett says the hardest part isn't the math. Nope, the real battleground for an investor is the 6 inches between your ears. He gets asked this constantly. I mean, at every shareholder meeting. And everyone expects this complex answer, inflation, interest rates, a market crash. But his answer just cuts through all that noise and points right back at the person asking the question. That's it, plain and simple. The average investor's single biggest obstacle to winning isn't the market, it's their own behavior. Our basic instincts for fear and greed, which, kept us alive out on the savannah, are a total disaster in the financial markets. We are hardwired to do the exact wrong thing at the exact wrong time. And he's constantly warning about these specific mental traps. Overconfidence makes you think you can't be wrong, so you take on way too much risk. Loss aversion, that's the sharp pain you feel from a loss, which is literally twice as powerful as the pleasure from a gain. That's what causes people to sell everything in a panic at the very bottom of the market. Herd mentality, that's that deep fear of missing out, the thing that drives people to pile into speculative bubbles right before they pop. And confirmation bias is our habit of only looking for news that agrees with what we already think, creating this dangerous little echo chamber. Buffett's real genius isn't just that he's smart, it's that he has spent a lifetime fighting to counteract these perfectly natural and totally destructive human impulses. And this right here just brilliantly illustrates his commitment to being rational. He is famous for his intellectual honesty. He doesn't try to hide his mistakes, he puts them on display. In his annual letters to shareholders, he'll openly write about his huge blunders, like buying Dexter Shoe Company, which he called a disaster that cost shareholders billions. By admitting his mistakes so publicly, he protects himself from the arrogance that destroys so many other successful people. He basically treats his mistakes as tuition he paid to the school of business, and he makes sure everyone learns the lesson. All right, let's move on to our final section, a legacy beyond wealth. Because the more you study Buffett, the more you realize that his teachings on business are totally inseparable from his teachings on how to live a good life. This quote from Todd Finkle, the author we've been referencing, is so telling. Finkle would take his university students to meet Buffett, and afterward, they weren't all buzzing about price-to-earnings ratios. No, they were talking about his humility, his ethics, his sense of humor, and his advice on reputation. It just proves that the thing that really sticks with people isn't the wealth, it's the wisdom. And nothing, absolutely nothing, demonstrates those values more powerfully than this number, over 99%. Pledging to give away virtually your entire fortune is, well, it's a radical statement. It's the ultimate rejection of using wealth as a personal scorecard. Through the giving pledge, he's basically arguing that these huge fortunes aren't just a private possession but a public trust, a resource that should be used to solve society's biggest problems. So these are the principles he truly lives by. He famously says, it takes 20 years to build a reputation and 5 minutes to ruin it. On integrity, he says, it's better to hang out with people better than you. You'll drift in that direction. He always stresses communication skills. But maybe the most important one is his idea of the inner scorecard. Are you driven by your own standards, or are you driven by what other people think of you? Living by that inner scorecard, that's the key to real success and happiness. In the end, Buffett's whole life is really a testament to the magic of compounding. But the most powerful thing he compounds isn't money. It's wisdom, it's trust, it's reputation. He used the first half of his life to build a fortune and is using the second half to give it all away, along with all the lessons he learned doing it. His story really challenges all of us to think about, what are we compounding in our own lives? It's about investing, for sure, but ultimately, it's about investing in yourself. Thanks for joining this Explainer.
Welcome to The Explainer. We've all heard the name Warren Buffett, right? The Oracle of Omaha. But have you ever really stopped to think about how he got there? How does a kid from the middle of Nebraska become one of the most legendary investors in the history of the world? Well, to really get it, you have to go all the way back to the beginning. The clues were there right from the start.
This is classic Buffett. It's the kind of long-term thinking he's famous for. But here's the thing. This quote tells you how to keep a great reputation. It doesn't tell you how he built that incredible reputation in the first place. So how did he do it?
The answer isn't buried in some complex financial statement or a Berkshire Hathaway annual report. Nope. The real secret, the origin story, is in his childhood. So let's peel back the layers and take a look.
Okay, so let's start with what makes Buffett so endlessly fascinating. It's this core contradiction, this paradox at the heart of who he is. He's this absolute giant of finance, but he lives this famously simple, down-to-earth life.
I mean, just look at these two sides of the same coin. On one hand, you have the Oracle, a ruthless capitalist who built one of the most valuable companies on the planet. And on the other, you have this gentle, humble guy from Omaha who's giving away almost his entire fortune and becomes the voice of calm when the world is freaking out. How do you square those two things? That's the Buffett mystique.
So where did this incredible drive come from? You might think he learned it at Wharton or Columbia Business School, but you'd be wrong. This entrepreneurial fire, this hunger to build things, it was there from the very beginning. We're talking since he was 6 years old.
Just look at this timeline. It's incredible. This wasn't just a kid with a paper route. At 6, he's selling gum and already has his own business ethics. He wouldn't sell single sticks because it wasn't a good deal for him. Then he's arbitraging Coca-Cola, figuring out profit margins. By 11, he's in the stock market. By 15, he's a real estate investor, a landlord, and in high school, he builds a legit pinball machine empire that he sells for a profit. This wasn't a hobby. This was a calling. And what was the result of all that hustle? $6,000. Now listen, for a 16-year-old in the 1940s, that's an insane amount of money. It's the equivalent of over $76,000 today. He'd already built a small fortune before he could even legally drive a car. That desire to work for himself was just fundamental to who he was.
But here's the thing. It would be a huge mistake to think his journey was just one win after another. Not even close. In fact, some of his most deeply held principles, the rules he lives by, they weren't born from success. They were forged in failure and frustration.
One of his earliest and toughest lessons came from his own grandfather, Ernest. After a huge blizzard, his grandpa put him and a friend to work shoveling out his entire grocery store property. And we're talking 5 straight hours of just grueling, back-breaking work in the cold.
So when they're finally done, totally exhausted, his grandfather basically offers them pocket change, not even $1 for the two of them. And in that moment of pure frustration, a light bulb went off for young Warren, a lesson he would carry for the rest of his life. Always know the terms of the deal before you do the work. Always.
So that was a lesson in negotiation, learned the hard way. His next big lesson came from his first dive into the stock market. And this one was all about controlling your emotions.
So check this out. At 11, he buys his first shares. The stock immediately drops, and he does what pretty much everyone does. He panics. He holds on just long enough to make a tiny little profit, sells, and breathes a huge sigh of relief. But then, he had to sit there and watch that same stock rocket all the way up to $200 a share. Ouch! That is a painful but priceless lesson in the cost of impatience.
This story right here is pure quintessential Buffett. While he's in college, he learns his hero, the legendary investor Benjamin Graham, is on the board of a company called GEICO. So what does he do? On a Saturday, he hops on a train, goes to their headquarters in D.C., and just starts knocking on the door until a janitor finally lets him in. He finds the one executive who's working that weekend and proceeds to grill him for 5 hours about the insurance business. I mean, who does that? That's not just taking initiative, that's a whole other level of hunger.
And all these stories, the hustle, the hard lessons, that relentless drive, they are all deeply rooted in one place. You just cannot separate the man from Omaha, Nebraska. It's that simple. This was the family motto, straight from his grandfather, Ernest. Frugality, self-reliance, and a deep, deep hatred of debt. This wasn't just some financial advice. It was a way of life that was baked into his DNA, and it became the bedrock of his entire investment philosophy. You also have to remember the time he was born into, the very heart of the Great Depression. The year after he's born, his dad loses his job, and the family loses every penny they had in the bank. They had to get food on credit from his grandfather's grocery store. Experiencing that kind of financial terror firsthand created this powerful, lifelong resolve to never, ever be poor or dependent on anyone ever again.
And Omaha itself played a huge part. As his son Peter said, it was a place of simplicity and integrity. There wasn't a lot of flash or distraction. It was a culture that valued hard work and keeping your head down. It was the absolute perfect incubator for a guy like Buffett to just focus intensely on his craft.
So what can we all take away from this?
Buffett's early life isn't just a great story, it's practically a blueprint for how to cultivate that entrepreneurial mindset in yourself.
You know, when you look at what the most successful founders do, you see these themes again and again. They get their hands dirty with real experience, they learn constantly, they surround themselves with smart people, and crucially, they know their own weaknesses. They stick to what they understand, just like Buffett.
And what is it that really drives them? Sure, the money is a huge factor, no doubt about it. But look what's at the very top. Independence. That burning desire to be your own boss, to answer to no one. That's the feeling that drove that 6-year-old kid selling gum door to door.
So, if you're looking to follow in those footsteps, here's a practical roadmap. Build your network. Find mentors, just like Buffett did with Benjamin Graham. Get real-world experience. And, maybe most importantly, get out there, try new things, and don't be afraid to make mistakes. That's where the real learning happens.
In the end, it really comes down to this combination of traits, doesn't it? That high drive to achieve, that need for independence, and a willingness to take calculated risks. It's all about being resourceful, having high energy, and maintaining a kind of stubborn optimism, even when things get tough.
But if there's one single lesson to take from Warren Buffett's entire origin story, it's probably this. True success, the kind that lasts, doesn't come from following the herd. It comes from thinking for yourself and having the courage to go in the opposite direction.
From a 6-year-old with a pack of gum to a global icon, the whole journey was built on hustle, on hard lessons learned, and on an unbreakable, independent spirit. And that's a pretty powerful idea to leave you with.
Welcome to The Explainer. Today, we're cracking open the blueprint of a legend, Warren Buffett. But we're not talking about the Oracle of Omaha, today. Nope. We're going way back to uncover the key lessons, the crucial mentors, and, yeah, even the critical mistakes that shaped his journey long before he was a household name.
So, you might think we'd start with a stock tip, right? Some secret formula? Wrong. We're starting with a single, powerful idea that a young, kind of awkward Warren Buffett used as his secret weapon. And this principle, from Dale Carnegie, is arguably one of the most important tools he ever acquired, and it has absolutely nothing to do with balance sheets.
So here's our game plan. We'll see how he learned to win people over, we'll follow him as he finds his most important teachers, and then we'll see how he put all those pieces together to create the very blueprint that would build an empire.
All right, let's jump in. Our first stop isn't Wall Street. It's not even a business school. It's a public speaking class. This is where Buffett learned that the greatest asset isn't capital, it's communication.
You gotta picture this. A young Warren Buffett who was an absolute genius with numbers, but also, well, painfully awkward. He had this huge realization that being a financial wizard meant nothing if he couldn't connect with people, persuade them, or lead them. So he shelled out $100 for this course, and to this day, he claims it was the single best investment he ever made. Think about that. It's not his fancy college diplomas hanging on his office wall, it's his Dale Carnegie certificate.
And just look at these principles. This isn't Wall Street stuff, is it? This is human stuff. Things like don't criticize, smile, and remember a person's name. Buffett totally absorbed this. He figured out that making someone feel heard, really listening to them, was way more powerful than any complex financial model. And then came part 2, persuasion. For Carnegie, this wasn't about being the smartest guy in the room or winning every argument. No way. It was about empathy. It was about avoiding arguments, admitting when you're wrong and doing it fast, and genuinely trying to see things from the other person's side. These skills would become his secret weapon in pretty much every deal he ever made.
Okay, so next up is college. But for Buffett, this wasn't some grand intellectual journey. He was, let's just say he was pretty much dragged there. And this really sets up a huge theme in his early life: the classroom versus the real world. I mean, he was the definition of a reluctant student. His dad pushed him to go to Wharton, one of the best business schools on the planet. And what does he do? He complains that he already knows more than the professors. For him, the real education wasn't in a textbook. It was out there, delivering newspapers, running his pinball machine business as a kid. That's where he felt he was really learning.
But then, everything changed. A major rejection that honestly turned out to be the best thing that ever could have happened to him. Why? Because it led him straight to the man who would give him the intellectual framework for his entire career, his true mentor.
So get this, Harvard Business School turns him down flat. He's crushed. But then he picks up this book, The Intelligent Investor by Benjamin Graham, and it just clicks. Everything makes sense. He finds out Graham is teaching at Columbia, so he dashes off this now legendary, kind of smart aleck letter that basically says, "Hey, I thought you guys were dead."
That one brash move kicked off the most important mentorship of his life and sent him packing to New York to learn from the godfather of value investing himself. And this concept, margin of safety, was Graham's gospel. You got to remember, this is a guy who got wiped out in the Great Depression. So for him, investing wasn't about getting rich quick. It was about not going broke. Margin of safety was his ironclad rule. And it's simple, really. If a business is worth $1, don't you dare pay $1 for it. You pay 50 cents. That way, if you're wrong or if something totally unexpected happens, you've got a cushion. It's a survival mechanism.
Buffett just got it. He soaked it all up. In fact, he became the only student Graham ever gave an A+ to. Ever. But here's the kicker. Even after that, when Buffett asked for a job, Graham said no. But Buffett didn't give up. He just kept at it, sending him ideas, until a few years later, Graham finally caved. He finally got the call to go work for his hero on Wall Street.
But Graham's philosophy was only half the equation. It was all about the numbers, the price you pay right now. Buffett's next great mentor, Philip Fisher, will provide the crucial missing piece, focusing on the future quality of a business.
And this really shows the contrast perfectly. It's like two sides of the investing brain. Graham taught him to find a bargain by asking, what is it worth now? But Fisher taught him to find a great business by asking, what will it be worth in the future? Graham was the numbers guy. Fisher was the story guy, who believed in gathering first-hand knowledge, a method he called scuttlebutt. And the Amex scandal is the perfect example of scuttlebutt in action. A massive fraud scandal hit a company connected to Amex and Wall Street panicked. The stock crashed more than 50%. But while everyone else was selling, what did Buffett do? He hit the streets. He went to restaurants and banks and just watched. And he saw that people were still using their Amex cards. He talked to them. He confirmed the brand itself was rock solid. So he ignored the panic, invested a huge chunk of his fund, and made an absolute killing. So, after his mentor, Graham, retired, Buffett heads back home to Omaha with about $127,000. He's only 25 years old, and he's planning to retire. Seriously, but his career as one of history's greatest entrepreneurs was about to kick off, completely by accident. It all starts in his bedroom with just over $100,000 from 7 friends and family members. And Buffett himself? He only put in $100. From that tiny, humble start, it just exploded. And the best part is, he never asked a single person for money. His incredible results and his reputation did all the talking, and people just started lining up to give him their savings to manage.
But here's a fascinating lesson. Even the masters make mistakes, and sometimes they're emotional ones. He got into a dispute over 12.5 cents a share with the manager of a failing textile mill called Berkshire Hathaway. He got so infuriated that out of sheer anger, he bought control of the whole crummy company. He later called it his biggest investment mistake by a mile, though he did wisely keep the name for his new investment vehicle.
So, what happens when you combine all these different pieces, all these distinct, powerful philosophies? Well, you get the blueprint. You get the formula that built Berkshire Hathaway and one of the world's greatest fortunes.
And here it is. This is the secret sauce. His success wasn't just one thing. It was a powerful combination. From Dale Carnegie, he got the people skills. From Benjamin Graham, he got that ice-cold price discipline. And from Philip Fisher, he learned how to spot truly great businesses by doing his homework. You put those 3 things together, and that's what made him unstoppable.
And the proof? It's right here in the numbers. I mean, just look at this. The market was chugging along at about 9% a year, but Buffett's blueprint was a wealth creation engine, generating almost 32% annually. Even after his fees, his partners were compounding their money at over 25% a year. This was a truly remarkable performance.
So from that accidental start in his bedroom, with just $100 of his own money, the foundation for a legendary fortune was built. By the time he dissolved the partnerships to focus on Berkshire Hathaway, they were worth a staggering $100 million.
And that leaves us with this final thought. We often look at Buffett as this one-of-a-kind genius, but his own story suggests something different, doesn't it? It suggests that greatness isn't just born, it's meticulously built, piece by piece, from lessons that are out there, available for anyone who is willing to learn them.
All right, welcome to The Explainer. Today, we're diving into the mind of a true genius, a man who is the quiet architect behind one of the greatest financial success stories in history. He was Warren Buffett's partner, his sounding board, and so much more. The one and only Charlie Munger.
I mean, you just gotta love that.
That single quote tells you almost everything you need to know about him. It's not just funny, it's who he was. Munger saw himself as a learning machine. For him, reading and gaining wisdom wasn't just a pastime. He believed it was a moral duty. It was the absolute core of his being.
For 60 years, he stood beside Warren Buffett at Berkshire Hathaway. Now, everyone knows Buffett, right? The Oracle of Omaha. He was the public face. But Munger was the architect in the shadows. He was the intellectual force who challenged every idea and helped build the very foundation of their philosophy.
And just listen to this. This comes straight from Warren Buffett himself. This is not just some casual compliment you pay a friend. This is arguably the greatest investor of all time admitting flat out that he found someone who was both smarter and wiser than he was. That one quote tells you everything about the power of their partnership.
You know, the crazy thing is, their paths were so close for so long. They grew up in the same city, Omaha. They even worked at the same grocery store when they were teenagers, just at different times. But they didn't actually meet until a dinner party in 1959. And that one night kicked off a friendship that would span more than 60 years and literally change the world of investing.
But to really get who Charlie Munger was, you have to go back to the beginning. His worldview wasn't developed in a comfortable boardroom. Oh no, it was hammered into shape by some of the biggest, toughest events of the 20th century.
Just take a look at this journey. He was born into the good times of the 20s, but then, bam, the Great Depression hits. He saw what real poverty looked like, and it lit a fire in him to get educated. Then he serves as a meteorologist in World War II. And in a move that is just so quintessentially Munger, he talks his way into Harvard Law School without even having an undergraduate degree, and then graduates with high honors. Every single step was a lesson in how to be tough and how to think.
And all of this led to his core philosophy, which he actually got from his grandfather. For Munger, the goal wasn't to be a genius. The goal was to be consistently not stupid. Think about that. It's about avoiding errors. He felt you had a moral obligation to be as rational as possible and to fight against lazy thinking. That idea was the bedrock for everything he did.
So what happens when a guy with this philosophy teams up with Warren Buffett? Well, a revolution happens. Munger didn't just come in and offer a few tips. He completely changed the game, sparking one of the biggest shifts in modern investing.
This really lays it all out. Buffett's original method, from his mentor Ben Graham, was called cigar butt investing. You'd find a terrible company that was so ridiculously cheap, it was like finding a discarded cigar on the street with one free puff left in it. It worked, but it was a grind. Munger came in and said, "Warren, why are we picking up soggy cigar butts? Why don't we just buy a wonderful company at a fair price instead of a fair company at a wonderful price?" It was a total game changer.
So, how did he prove he was right? With this number right here, $1.9 billion. That's the pre-tax profit Berkshire has made from a little chocolate company called See's Candies. See, Buffett was hesitant to pay what they were asking. He thought it was too expensive. But Munger pushed him, and See's became the perfect example of his philosophy in action. It proved that buying quality was the smarter long-term play. And in his typically blunt, hilarious way, Munger gave this strategy a great name: sit on your ass investing. The idea is simple. You do all the intense research and hard thinking up front, but once you've found one of those truly great companies, the best thing to do is nothing. You just sit on your ass and let the company do its thing. It's all about patience over frantic activity. But here's where we get to the real secret sauce, the Munger magic. His true genius wasn't just about business models and balance sheets. It was his incredible understanding of human psychology and all the ways our brains trick us into making terrible decisions. His big idea here was something he called the lattice work of mental models. You've heard the saying, "To a man with a hammer, every problem looks like a nail." Well, Munger thought most people in finance were walking around with just one hammer. He said you need a whole toolbox. You need to borrow the big ideas from psychology, physics, biology, history, all of it, and you weave them together into a lattice work in your mind that helps you see reality clearly.
And this leads to one of his best concepts, the Lollapalooza effect. It sounds kind of fun, right? But it's actually pretty dangerous. It's when a handful of these psychological biases all team up at once, pushing you toward a really bad decision. Think about a bidding war at an auction. You've got social proof because other people are bidding. You've got commitment bias because you've already started. All these things combined, and suddenly you're paying a crazy price for something. Munger knew how to spot these situations and just walk away.
And here are just a few of the mental traps he warned us about. He always said it wasn't greed that drove the world, it was envy.
Deprival superreaction, well, that's just a fancy 1950s name for FOMO, the fear of missing out. Then you have commitment and consistency, where you stick with a bad idea just because you already committed to it. Social proof, of course, is just following the herd. And self-serving bias, where every win is because you're a genius and every loss is just bad luck. Munger's whole life was about building systems to avoid these huge, stupid mistakes. So you can see how powerful these ideas are for investing. But what's truly amazing is that for Munger, this wasn't just a business strategy. It was a complete philosophy for how to live a good, effective, and rational life. This is where it all ties together. These 4 rules are just a masterclass. First, deserve what you want. So simple, so powerful. The most reliable way to get things in life is to earn them. Second, know your competency edge. This is all about humility. Know what you're good at, but more importantly, know what you don't know. Third, avoid self-pity. Every screw-up, every bit of bad luck is just a chance to learn something. And finally, the engine that drives it all. Always keep learning. Just try to go to bed every night a little smarter than you were when you woke up. Munger loved to tell this one story that perfectly sums up his whole approach. A young guy asks Mozart how to write a symphony. Mozart says, "You're too young. Start with something smaller." The kid gets annoyed and says, "But you were writing symphonies when you were 10. And Mozart's reply is just classic. He says, "Yes, but I wasn't running around asking other people how to do it." The point is, you can't look for shortcuts. You have to put in the work yourself. So that leaves us with one final thought. Charlie Munger spent 99 years patiently building his latticework of mental models, trying to get a little wiser every single day. He showed all of us that the greatest investment you can possibly make isn't in stocks or bonds. It's in your own understanding of the world. So the real question he leaves behind is for us. What models are you building in your own latticework? You know, Warren Buffett didn't become one of the wealthiest people on the planet by following the crowd. Nope. He did the exact opposite. So today, we're going to pull back the curtain on the surprisingly simple yet incredibly powerful philosophy that turned a tiny textile company, Berkshire Hathaway, into an absolute global powerhouse. And more importantly, we'll see how you can actually apply these timeless lessons to your own financial life.
Let's start with this quote from Philip Fisher, who is a huge influence on Buffett. This one sentence right here, it just cuts to the very heart of everything we're about to talk about. That critical and often totally overlooked difference between the price you pay for something and the true underlying value you actually get. All right, here's our game plan. We're going to start with Buffett's big pivot in his thinking. Then we'll dig into this wild investigative method he adopted called scuttlebutt. After that, we'll break down Berkshire's 3 core pillars for looking at a business. We'll get into Buffett's specific playbook just for you, the individual investor. And we'll wrap up with what might be the most important piece of the puzzle, the investor's mindset. First up, a legend's great pivot. See, a lot of people think Buffett has always invested the same way, but that's not true at all. He actually started out with a strategy he learned from his mentor, Benjamin Graham, which is famously known as cigar butt investing. Now this slide, this really shows you the huge shift. On the left, you've got the cigar butt style. Think about it like this. It's like finding a used cigar on the sidewalk. It's kind of gross, it's not going to last, but hey, you get one last free puff. You're buying a terrible company for next to nothing just to squeeze out that last little bit of value. But on the right, you have the Munger and Fisher philosophy. That's about buying a great company at a fair price. So it's less about the quick, cheap bargain and all about investing in long-term, lasting quality. And this is where Buffett's genius really shines. He didn't just throw out his old mentor's ideas. No, he blended them. He took Graham's hardcore quantitative analysis, that's all the numbers, the balance sheets, the hard data, and he fused it with Fisher's deep qualitative insights. That's the stuff you can't just plug into a spreadsheet. How good is the management? How strong is the brand? This mix, this became the secret sauce for everything Berkshire Hathaway is today. So let's see how this builds, which brings us to our second section, the scuttlebutt investigation. This was Philip Fisher's big idea, and honestly, it feels more like being a detective or an investigative journalist than just a stock analyst. So what in the world is scuttlebutt? Well, it's basically the art of getting the real story, the inside scoop. It means you don't just sit there and read the perfectly polished annual report. No, you get out there and you talk to real people to understand a business from every single angle. You're looking for the kind of information that will never show up on a financial statement. And who are you talking to? You're talking to everybody.
You talk to customers to find out if they actually love the product. You talk to competitors to see who they're really afraid of. And, oh yeah, you definitely talk to former employees. They might just give you the unvarnished truth about what's really going on inside a company. Every person you talk to gives you another piece of this giant puzzle.
And this all leads to another one of Fisher's core beliefs. He said if you've done all this deep dive scuttlebutt research and you've bought a truly fantastic business, why on earth would you ever sell it? The best time to hold it is forever. And this isn't just a nice idea, it's incredibly practical. You minimize taxes, and you let that investment just compound year after year after year for decades.
Okay, so we've got the philosophies down. But how does Berkshire actually put this into action? Well, that brings us right to Section 3, Berkshire's 3 pillars. It's a simple but incredibly powerful way to understand any business.
It's a beautifully simple 3-step process. First, you got to understand the people running the show. Second, you have to understand the business they're actually in. And third, you have to understand what it is that protects that business from all the competition. Let's break each of those down.
So pillar number 1 is all about management. Buffett wants to know, are the people in charge honest? Are they good at their jobs? And, this is the big one, do they think like owners? A great way to check this is to look at their pay. Are they getting massive bonuses for short-term stock bumps, or is their compensation tied to the long-term health of the business? You want to see a team that's trying to create real, lasting value for everyone, not just for themselves.
Pillar 2 is the industry itself, and the key here is Buffett's famous circle of competence. Look, you don't need to be an expert on everything, but you absolutely have to understand the businesses you invest in inside and out. It's why Buffett stayed away from tech stocks for so long. He just said, I don't get it. He compares it to baseball. Knowing your circle of competence is what lets you stand at the plate and wait for that perfect pitch to hit out of the park.
And the third pillar is the moat. This might be the most famous Buffett idea of all. The moat is whatever a company has that protects it from invaders, just like a moat around a castle. It could be a powerful brand, like Coca-Cola, a bunch of patents, or just being the absolute cheapest producer out there, like Costco. A wide, deep moat is what lets a great company stay great for a really, really long time.
So that's how the pros do it. But what about the rest of us? Let's jump into Section 4, Buffett's Playbook for You. This is his super direct, actionable advice for the average person who, let's be honest, doesn't have time to do scuttlebutt investigations all day long.
To really hammer his point home, let's talk about his famous $1 million bet. Back in 2006, Buffett wagered that a super simple, low-cost S&P 500 index fund would crush a hand-picked group of fancy, expensive hedge funds over the next 10 years. It was the ultimate showdown, simple and cheap versus complex and expensive.
And the results? It wasn't even close. I mean, look at this. The simple index fund was up over 125%. The so-called smart money hedge funds, a measly 36%. The lesson here is crystal clear. The crazy high fees that active managers charge act like a giant anchor dragging down your returns. For most of us, trying to beat the market is a losing game.
And if you're still not convinced, just look at this number. Let's say your grandparents had put just $10,000 into a simple S&P 500 index fund back in 1942 and then just forgot about it. Through everything, wars, recessions, you name it, that one investment would be worth over $51 million today. That's the power of compounding. That's why Buffett always says, never bet against America.
So his advice for most people is just so simple but so powerful. Put 90% of your cash into a low-cost S&P 500 fund, the other 10% in short-term bonds. And then comes the hardest part, do absolutely nothing. Don't trade, don't watch the financial news every day, don't panic, just sit back and trust the long-term growth of the economy.
And you know, that leads us perfectly into our final and I think most important section, the investor's mindset. Because according to Buffett, success isn't really about how smart you are. It's about how well you control your emotions.
Which kind of begs the question, right? Do you need to be some kind of genius with a crazy high IQ to be a successful investor?
And Buffett's answer is a huge, resounding no. As he says right here, once you're reasonably smart, being even smarter doesn't really help. What you need is the right temperament. In other words, you don't need to be a rocket scientist, but you do need the emotional discipline of a Zen master. It's all about staying calm when everyone else is freaking out.
This slide really lays out the two paths. On the left, you've got the lemming investor. This person follows the crowd.
They get swept up in the excitement and buy when prices are at their peak. Then they get terrified and sell when prices hit rock bottom. The contrarian investor on the right does the exact opposite. They think for themselves. They have the courage to be, as Buffett says, greedy when others are fearful and fearful when others are greedy.
Which brings us to our final thought. The market is just an incredibly noisy, chaotic place, and it is constantly screaming at you to do something. So the entire philosophy we've talked about today really boils down to this one simple question. In a world that's begging you to swing at every single pitch, can you be the one with the discipline and the patience to just wait for the perfect one?
All right, today we're cracking open the playbook of one of the most successful investment philosophies in history, the Berkshire Hathaway method. We're going to get right inside the mind of Warren Buffett and figure out the core principles that took a tiny company and turned it into an absolute giant. So let's just dive in.
To really wrap your head around the scale of Berkshire's success, just look at this number. In 2022, a single Class A share of their stock would have set you back $500,000. That's the highest price for one share of any company ever. And when you see a number like that, it really only leads to one question.
How do Warren Buffett and his partner Charlie Munger pull this off year after year? Is there some secret formula, some crazy complex algorithm they're using? Well, the answer is actually a lot more straightforward than you might think, and we're about to break it all down.
So here's our roadmap. We'll kick things off with the absolute cornerstone of their philosophy, the margin of safety. Then we'll get into the art of it all with their qualitative checklist, followed by the science with their quantitative toolkit. We'll see it all come together with the classic C's Candies case study, and then we'll finish with the real secret ingredient that makes it all work.
Everything, and I mean everything in the Berkshire universe starts right here. It's with what Buffett calls the three most important words in investing: margin of safety. Now, this is an idea he picked up from his mentor Benjamin Graham, but as you're about to see, he put his own very, very profitable spin on it.
So what in the world is a margin of safety? Well, just think of it as a financial buffer, a cushion. Ben Graham's whole idea was that you should only buy a stock when its price on the market is way, way below what you think it's actually worth. Now, that doesn't mean you'll always be right, but it gives you a ton of room for error. It's a super conservative, defensive way to play the game.
And this is where Buffett's thinking really took a turn. See, Graham was known for what he called the cigar butt approach. Finding these pretty mediocre companies on the ground that had maybe one last puff of profit left in them. But Buffett, with a big nudge from Charlie Munger, completely flipped that idea on its head. He figured out that it's so much better to pay a fair price for a wonderful company than a wonderful price for a fair company. And wow, that little shift changed absolutely everything.
And this quote just nails the mindset perfectly. Buffett isn't trying to calculate a company's value down to the last penny. He's looking for businesses that are so obviously, ridiculously valuable that you just can't miss it. It's like he says, when you see a fat guy, you don't need a scale. If you have to break out a supercomputer to figure out if something's a good deal, it probably isn't one. The value should just jump right out at you.
Okay, so if it's not just about getting a bargain, what makes a business great? This is where we move away from the spreadsheets and get into the qualitative stuff, what Buffett and Munger call the art of investing. This is all about really understanding the business itself, not just its stock price.
When you boil it all down, their search really comes down to these three things. First, the business has to be really good at making money from its physical assets, its factories, its inventory, that kind of stuff. Second, the people running the company have to be both smart and trustworthy. And third, even if it's the best business in the world, you can't pay a crazy price for it. The price has to be sensible. This is one of Buffett's all-time greatest lines, and it just perfectly captures that move away from pure bargain hunting, right? Why would you want to own 100% of a cheap piece of glass when you could own a tiny slice of the Hope Diamond? It just crystallizes this idea that quality is what matters most in the long run. A huge part of finding that quality is looking for what Buffett calls an economic moat. And the analogy is perfect. A moat protects a castle from being attacked. In business, a moat protects a company's profits from its competitors. This could be a brand that no one can touch, like Coca-Cola, or it could be a super low-cost way of doing business that nobody else can copy, like GEICO has. And beyond the moat, they're looking for other clues of strength. They love stable industries that aren't changing every 5 minutes. They look for businesses where a super loyal customer base gives them the power to set their own prices. And this is a big one.
They invest in systems, not in some single genius CEO. They want a business that's so good it can run itself, no matter who's in charge.
Okay, we've covered the art. Now let's switch gears and talk about the science. This is where we do take a peek at the numbers. But don't worry, like Munger says, this is basically just high school algebra. It's not about doing complicated math. It's about knowing which few numbers actually tell the true story.
So first up is return on equity, or ROE. This is a huge one for figuring out how efficient a company is. Put simply, it answers one question. For every single dollar the owners have invested in the business, how much profit does it kick out each year? A consistently high ROE, that's the sign of a serious profit-making engine.
And the formula itself is super simple. You just take the company's final profit, its net income, and you divide it by what the owners actually have at stake in the company, their equity. It's just a clean, powerful way to see how well management is using the owner's money to create even more money.
Next up, they look at debt. The debt-to-equity ratio is kind of like a quick financial health check. It asks, is this company running on borrowed money, or is it running on its own money? Buffett has always been really cautious about companies taking on too much debt, so he's looking for ones that are standing on their own 2 feet.
And again, the math isn't going to scare you. It's just all the company's debts divided by the owner's equity. Generally, if you see a number less than 1.0, that's a great sign. It means the business has more of its own money than borrowed money. It's a clear signal that the company is stable and not taking wild risks.
And finally, we get to what many believe is the true lifeblood of any business, free cash flow. Now, this isn't some accounting number. This is the actual cold, hard cash the company has left over after paying all its bills and making necessary investments. This is the cash that lets a company expand, pay back its owners, or innovate. A business that gushes free cash flow is a very, very healthy business.
All right, so theory is one thing, but let's actually see how this whole framework comes together in the real world. And honestly, there is no better example of the Berkshire method in action than one of Buffett's all-time favorite investments, a little California chocolate company called See's Candies.
The numbers here are just staggering. Berkshire bought See's way back in 1972 for $25 million. Since then, it has generated over $2 billion in pre-tax income. But here's the real kicker. It only needed about $40 million more in capital to do it. It was like buying a goose that laid golden eggs and never had to be fed. That is the power of buying a truly great business.
This chart just shows you the story. When they bought it, See's was making less than $5 million a year in profit. Today, it makes around $80 million. And why? Because it has that powerful moat we talked about, a brand that people absolutely adore, which gives it incredible pricing power. They could jack up the price of a box of chocolates every single Christmas, and their loyal customers would just say, "Thank you, here's my money."
I love this Buffett quote. It's hilarious, of course, but it also gets at something really important. He genuinely loves the products of the companies he owns. He gets them. He understands why people love them. He invests in things he knows and trusts, which is a huge part of the whole philosophy.
So as we bring this all home, what's the real secret sauce here? What's the ultimate lesson from the Berkshire Way? Well, it's not some magic formula. It's a blend. It's a disciplined combination of 2 different ways of looking at the world, mixed with a superhuman amount of patience.
And really, that's the big takeaway. The science part, well, that's the easy bit. It's the ratios, the cash flow. Anyone can learn to do that math. The art, that's the tough part. That's judging the things you can't put in a spreadsheet, the quality of the brand, the honesty of the managers, the durability of that moat. The real genius of Buffett and Munger isn't just knowing the rules, it's mastering both the art and science, and then having the patience to sit on your hands and wait for that one perfect opportunity.
Welcome to The Explainer. Today, we are diving deep into the mind of Warren Buffett. We're going to break down his genius by looking at 2 of his biggest, most important investments ever. First, the insurance company that taught him a lesson he never forgot, GEICO. And second, the tech giant almost nobody saw him buying, Apple. Everything you need to know about how Buffett thinks is right here in this quote. He's not saying you need to be a math whiz or have some secret formula. Nope. He's saying success is all about your psychology. It's about keeping your head when everyone else is losing theirs, staying calm and rational when the market is going crazy with fear or greed. So what does this temperament actually look like in the real world? Well, we're going to see it in action through 2 of his most defining investments. And by putting them side by side, we can really start to see the simple, powerful ideas that built his entire fortune. Okay, first up, GEICO. Our story starts way back at the very beginning of Buffett's career, and it's all about a painful mistake, a $1 million lesson, really, that ended up shaping his entire philosophy for the rest of his life. Now, you can see right here, his relationship with GEICO wasn't some quick, one-and-done deal. It was a 40-year saga. It started with him being a curious student, then making a huge mistake, and finally making this incredible comeback. This one company really became the bedrock of his whole empire. The story of how he found GEICO is just fantastic. Picture this. It's 1951. Buffett is only 20 years old. He goes to their headquarters on a Saturday, finds the place empty, and literally just starts knocking on doors until a janitor lets him in. He ends up in a 5-hour meeting with a top executive. And in that one conversation, he gets it. He figures out the 2 secrets to their business, this magical thing called insurance float, and their huge cost advantage because they sold directly to people. That's what he'd later call a moat. He was so excited, he put more than half of his entire net worth into the stock. A year later, he sold it all for this amount, a nearly 50% profit. For a young guy, that's a home run, right? You'd think so. But this is where the real story begins. Here's the kicker. That short-term profit turned out to be a long-term disaster. He sold to chase some other stock that looked like a better deal. And then he had to sit and watch as his GEICO shares went to the moon. That small stake he sold, 20 years later, it would have been worth over $1 million. Ouch. That painful lesson became a core part of his DNA. And this experience completely changed his game. See, he learned from his mentor to buy these cheap, beat-up companies, he called them cigar butts, with one last puff of profit left in them. But after this, he realized, no, the real path to getting rich is to find a truly wonderful company and just hold on for dear life. So fast forward 20 years, Buffett gets his second chance. GEICO is in huge trouble, on the verge of bankruptcy. The stock had crashed from $61 all the way down to $2. The market was panicking. But Buffett, he was rational. He knew the business was still good underneath all the mess. He jumped back in, invested $19 million, and that stake grew to be worth over $1 billion. Incredible. Let's just quickly go back to that float idea because it's so important. Think of your own insurance. You pay your premium today, but you might not have a claim for years, if ever. Well, the insurance company gets to hold on to your money, and millions of other people's money in the meantime. That giant pile of cash is the float. It's basically a massive interest-free loan that Berkshire Hathaway gets to invest for its own profit. This is the engine that has powered Buffett's whole operation for decades. Okay, now let's jump way ahead to 2016. For years and years, Buffett was famous for saying he wouldn't touch tech stocks. He'd say, I just don't understand them. So you can imagine the shockwaves when Berkshire started buying billions and billions of dollars of Apple. I mean, this move had everyone scratching their heads. Had Buffett totally lost it? After avoiding the whole dot-com bubble? After sitting out years of tech booms? Why on earth was he suddenly betting the farm on Apple? Well, the answer is actually pretty simple. Buffett didn't change his rules. He just changed how he looked at the company. He didn't see Apple as a tech company with complicated circuits and code. He saw it as a consumer products company with a brand that was practically a religion. He understood the loyalty. He understood how once you have an iPhone, you get an Apple Watch, then a Mac, that sticky ecosystem. He wasn't betting on the next gadget. He was betting on the power of the brand itself. And wow, did the numbers back him up. Just look at this metric, return on equity. It basically shows how much profit a company makes for every dollar investors put in. Now, Buffett likes to see a consistent ROE over 15%. Apple's ROE isn't just high, it's accelerating like a rocket ship. That's the sign of an unbelievably dominant business. And this chart, this shows the real powerhouse behind Apple. It's free cash flow. This is the actual cash the company has left over after running the business and reinvesting for growth. It is an absolute river of money, and this cash gives Apple the power to do pretty much whatever it wants, innovate, buy other companies, and send huge checks to its shareholders. Now here's where it gets really fascinating. It's like history repeating itself. In 2020, Berkshire trimmed its Apple position a little bit, and just a year later, Buffett came out and said, yeah, it was probably a mistake. It's an incredible echo of that lesson he learned with GEICO all those years ago. When you own a truly wonderful business, the smartest move is usually to just sit on your hands. So let's bring it all together. We've got GEICO and Apple, two totally different companies, bought decades apart. So what can we learn? What's the common thread here? Well, we can actually piece together Buffett's playbook. His whole method really comes down to two big checks. First, the qualitative stuff, the things you can't put in a spreadsheet. He has to understand the business, plain and simple. It needs to have a durable moat protecting it from competitors. And he absolutely has to trust the people in charge. If all that checks out, then he looks at the numbers for proof. The high return on equity, the strong profits, and, of course, that mountain of free cash flow. But there is one last, really crucial step. Finding a great company is one thing, but you can't overpay for it. And that brings us to the tricky business of valuation. Now, the textbook way to value a company is something called discounted cash flow. It sounds super technical, but the basic idea is just this. You try to predict all the cash a business is going to generate for the rest of its life, and then you work backwards to figure out what all that future cash is worth in today's money. But here's where Buffett and his partner Charlie Munger are different. Munger basically says, forget trying to be a genius with these complex models. The real advantage isn't being brilliant, it's just trying to stay rational. In fact, Munger has said he has never, not once, seen Buffett pull out a calculator or use a computer to figure out what a company's worth. He just does it in his head. And that's because for Buffett, valuation isn't a precise science, it's an art. It comes from a deep, deep understanding of the business and then making a reasoned judgment call. And that brings us full circle, right back to that key idea, temperament. In a world that is obsessed with complexity and trying to be brilliant, Buffett's greatest advantage has always been his commitment to just being rational. So I'll leave you with this question to think about. Where in your own life, in your job, your finances, anywhere, could you gain a huge edge, not by trying to be more brilliant, but just by trying to be more rational? Have you ever felt like investing is just a big game of chance? You know, you do all the research, you pick your stock, and then you just watch the market do its thing. And it feels like your skill had almost nothing to do with the outcome. Well, if you've ever felt that way, you are definitely not alone. In fact, you're in some very, very good company. Today, we're going to dive into how you can master your own investor mindset. Now, get this. This quote comes from Daniel Kahneman, a Nobel Prize winner. And he's not talking about you and me. He's talking about the professionals, the fund managers. He's basically saying that even the pros are often just getting lucky. So, I mean, if the experts are just rolling the dice, what hope do the rest of us have? It's a huge question, and it points to a fascinating truth about where real investing skill actually comes from. Well, the answer isn't some secret algorithm or a hot stock tip. It's actually an understanding ourselves. The secret weapon that legendary investors like Warren Buffett use isn't just about crunching numbers. It's a whole field of study called behavioral finance, and it's all about the human element, the psychology that drives the markets. Buffett himself says it comes down to two things. First, you have to know how to value a company. That's the technical stuff, right? That's what everyone focuses on. But it's the second key, understanding human behavior, that's the real game changer. That's what separates the good investors from the truly great ones. It's not enough to know what a business is worth. You have to understand the irrational, emotional minds of the people buying and selling it. So what exactly is behavioral finance? Well, it was pioneered by these two brilliant psychologists, Daniel Kahneman and Amos Tversky. And it's the study of how our own brains can sabotage us in the financial world. It looks at all the little psychological glitches and mental shortcuts, our biases, that cause us to make decisions that are, let's be honest, completely irrational, but in very consistent and predictable ways. And this slide just nails the difference. For decades, classical economics was built on this idea of a perfectly rational human, this imaginary person who always makes the most logical choice. Behavioral economics came along and said, whoa, hold on a second. That's not how real people work. It accepts that we are messy, emotional creatures driven by things like fear and greed, and that leads to some fascinating and often very expensive decisions. Okay, so let's meet the villains of our story. We're going to break down 7 of the most common psychological biases. Think of them as these sneaky mental traps that every single investor, from a total beginner to a Wall Street pro, has to fight against every single day. First up is maybe the most powerful one of all, herding bias. This is our deep, primal instinct to follow the crowd. We just assume the group must know something we don't. Warren Buffett's partner, Charlie Munger, has a great, blunt name for it. Following the lemmings. And believe me, no one is immune. Back in 2008, when oil prices were soaring and everyone was piling in, Buffett bought a huge amount of ConocoPhillips stock, right near the top. He later admitted it was a major mistake driven by the frenzy, a mistake that cost his company billions. It just goes to show the crowd is often most wrong right at the very top and bottom. Next up is loss aversion, and this one is a real cornerstone of behavioral finance. Here's the deal. Psychologically, the pain you feel from losing $1,000 is about twice as powerful as the pleasure you get from gaining $1,000. This emotional math makes us do crazy things. We'll sell our winning stocks way too early just to lock in that little bit of pleasure, but we'll hold on to our losers forever, hoping they'll come back just so we can avoid that sharp pain of admitting we were wrong. And this chart just says it all, doesn't it? Look at that bar for pain. It's literally double the size of the bar for pleasure. This is the emotional tug-of-war that's happening inside your brain every time you look at your portfolio. Just understanding that this lopsided feeling exists is the first step to making sure it doesn't control your decisions. Now let's talk about confirmation bias. Our brains don't want the truth, they want to be right. This bias means we actively go looking for articles, videos, and opinions that agree with what we already believe, and we ignore or find reasons to discredit anything that challenges us. And in today's world, with social media algorithms feeding us exactly what we want to see, this bias is on hyperdrive. It creates a dangerous echo chamber that makes you feel super confident right before you make a huge mistake. Then we've got recency bias. This is our brain's shortcut of thinking that whatever just happened is going to keep happening forever. It's why so many people pile into the fund that was #1 last year, or why they sell everything after a crash, assuming it's just going to keep going down. And even the masters can fall for it. In the spring of 2020, right in the middle of the pandemic chaos, Buffett sold all of his airline stocks for massive loss, a decision that was clearly colored by the immediate terrifying crisis that was unfolding right at that moment. Hindsight bias. We've all done this one. It's the I knew it all along effect. After something happens, our brain kind of rewires our memory to make us believe that the outcome was obvious from the very beginning. This is so dangerous because it stops us from learning from our mistakes, and it makes us way too confident in our ability to predict the future. Buffett and Munger even talk about this, saying that looking back, they should have known to buy Google and Amazon because they saw how powerful the companies were. But you know what? Hindsight makes everything look easy. Let's talk about a really modern trap, the talking heads bias. This is our tendency to give way too much authority to the so-called experts we see on TV or online, especially if they speak with a ton of confidence. We end up outsourcing our own thinking to them, but Warren Buffett has a really sharp warning about this. He says, market forecasters will fill your ear, but will never fill your wallet. Their job is to get ratings, not to make you rich. And finally, #7, mental accounting. This one's fascinating. We subconsciously put our money into different mental buckets. You know, a tax refund might feel like fun money that you can be reckless with, while your paycheck is serious money that needs to be protected. In investing, this leads to really weird decisions. An investor who needs cash might sell a winning stock because it feels good to take a profit, instead of selling a losing stock, which could actually be the smarter move because of taxes. You have to remember, all money is the same. A dollar is a dollar, no matter where it came from. So you take all of these biases, hurting, loss aversion, recency, and you throw them into a big market crisis. What do you get? Pure panic. But look at this slide. From the Great Depression to the COVID crash, one thing has been constant. Markets eventually recover. And what's even more interesting is that the recovery times have been getting way, way shorter. These crises are the ultimate test of your mindset. And history shows over and over again that the people who can control their biases and just stay the course are the ones who come out ahead. Okay, so we've identified the mental traps, and I know it can feel a little bit daunting. But here's the really good news. Once you can name them, you can start to fight them. Awareness is half the battle. So now let's build your toolkit with some clear, practical strategies you can use to protect yourself from your own worst instincts. All right, this is the slide you might want to screenshot. This is your cheat sheet. To fight hurting, you have to do your own homework. Think like you're buying the whole business, not just a little blip on a screen. For loss aversion, pre-commit to your exit point. A stop-loss order lets your rational brain make the call before your emotional brain can get in there and mess things up. To fight confirmation bias, you have to purposely seek out smart people who disagree with you. Read the negative report on a stock you love. For recency bias, zoom out. Look at a 10-year chart, not a 10-day chart. And to beat hindsight bias, the best tool is an investment journal. When you buy something, write down exactly why you're buying it. That way you can't trick yourself later. You'll have the receipts. So, after all of this, what's the big takeaway? It's a really simple but powerful shift in focus. The goal isn't to master the market. That's impossible. The goal is to master yourself. This quote really sums it all up. Successful investing isn't about having the highest IQ. It's about having the right temperament. It's about having the emotional discipline to stay rational when everyone else around you is either panicking or getting way too greedy. Understanding these biases is the key to getting that control. It's realizing that self-awareness is your single greatest financial asset. So here's the bottom line. We can never predict what the market's going to do tomorrow, but we can work on making our own behavior more predictable, more disciplined, and more rational. The real power isn't in forecasting the future, it's in controlling how you react to it. So, as we wrap up, I want you to ask yourself, looking at that list, which one of those mental traps sounds a little too familiar? And which one will you start working to conquer first?
All right, let's get right into it. Think about this for a second. How on earth does a company with just 25 people in a tiny office in Omaha, Nebraska, become a global empire worth over $750 billion? It sounds impossible, right? Well, the answer is all in the playbook of one man, Warren Buffett. And today, we're going to break down the exact strategies he used to turn Berkshire Hathaway, which was a failing textile company, into one of the most powerful forces on the planet.
You see this quote, this single sentence? This is everything. This is the key that unlocks the whole story. You can think of it as the philosophical North Star that has guided every single major decision we're about to talk about. It's not just some clever saying you'd see on a poster. Nope. It's the fundamental operating system for the entire Berkshire Hathaway empire. So, really, keep this one in the back of your mind as we go.
I mean, just look at this. The disconnect here is absolutely incredible. On one side, you've got Berkshire's actual headquarters. The Financial Times once said it has drop ceilings, narrow hallways, and tired carpets. Seriously, sounds like a community college admin office. But then, you look at the other side. You see the reality of its global power. A $754 billion empire with 360,000 employees. So the big question is, how does this tiny, frankly, boring, little office command a financial empire bigger than the economy of many countries? That's the puzzle we're here to solve.
Okay, so to figure this out, we're going to break it all down into 5 key plays right from Buffett's playbook. We'll look at how he acts as this sort of patient corporate entrepreneur, the secret engine that paid for everything, the iconic companies he snapped up, how he used market fear to his advantage, and finally, the philosophy of trust that, believe it or not, holds this massive empire together.
So first up, this idea of Buffett as a corporate entrepreneur. We all think of him as an investor, right? But that word doesn't really tell the whole story. He's not just buying stocks and sitting back, he's actively using Berkshire's enormous resources to shape companies from the inside. Now, unlike a lot of activist investors today who are just in it for a quick buck, Buffett plays the long game. He's all about patient, long-term growth.
But of course, to play that long game, you need cash. A lot of cash. And that brings us to the second and maybe most important play, the secret insurance engine. Look, every empire needs a treasury, right? A war chest to fund its expansion. For Berkshire, that engine was kicked into gear by one single, absolutely brilliant purchase way back in 1967. And I'm not exaggerating here. This wasn't just a good deal. It was the deal that made everything else you know about Berkshire possible.
And here it is. This is the one, the foundational move. In 1967, for just $8.6 million, Berkshire bought a company called National Indemnity. Now you have to remember, at the time, this probably looked like nothing special. Just another small insurance company. But Buffett, he saw something that nobody else did. He saw a machine that could print cash for him to go out and invest.
And hey, don't just take my word for it. Listen to the man himself. Decades later, Buffett said this. Just let that sink in for a minute. He's admitting that without this one single deal, the entire Berkshire empire might be worth less than half of what it is today. I mean, wow, that just goes to show you how absolutely crucial this single move was.
So what was the big secret here? It all comes down to a simple concept called insurance float. Here's how it works. Insurance companies collect all this cash from people's premiums up front, but they don't have to pay out claims until later, sometimes much later. This creates this giant, constantly refreshing pool of cash that the insurance company can invest for its own profit. For Buffett, this wasn't just a little extra cash. It was a massive, low-cost, almost free source of capital that fueled decades of shopping sprees. It was basically financial jet fuel for his empire.
Okay, so he's got the jet fuel. Now he needs a fleet of jets to put it in. This brings us to play number 3, acquiring Main Street legends. And this was a really big shift in his whole strategy. He started moving away from what his mentor, the famous Ben Graham, taught him, which was basically to buy any old cheap company you could find. Instead, Buffett started hunting for great companies, companies with amazing brands and real staying power that he could buy for a fair price.
And the perfect example of this? See's Candies. Just look at these numbers. It's insane. He puts in $25 million back in 1972, and since then, that one investment has generated over $2 billion in pre-tax income. How is that possible? Well, it's because See's has customers that are almost fanatically loyal. They can raise their prices every single year, and people just keep buying. That is the perfect Buffett company, right there.
And what Buffett saw in a company like See's is something he famously calls a business moat. The idea is simple, right? Just like a moat protects a castle, a strong, durable, competitive advantage protects a company from its competitors. For See's, that moat is its brand. Everyone knows it, everyone trusts it, and that moat is what Buffett values more than almost anything. He's not just buying a company, he's buying its fortress.
But it wasn't just about the brands, it was about the people behind them. And there's no better story to illustrate this than the one about Rose Blunkin, or as everyone called her, Mrs. B. Just picture this. She's an immigrant from Russia, comes to America, can't read or write English, and in 1937, with just $500 to her name, she starts a furniture business in a basement. I mean, she's the absolute definition of the entrepreneurial spirit that Buffett just loves.
Her strategy was so simple it was brilliant. Sell cheap and tell the truth. That's it. She would undercut her competitors so aggressively that they actually got together and tried to sue her out of business. But Mrs. B, she was tough. She fought them in court, and you know what? She won, proving her model of low prices and high volume was totally legit.
And here's where the story gets legendary. The judge in that lawsuit was so blown away by her business savvy that after he acquitted her, he walked out of the courtroom and bought carpet from her store. Years later, when Buffett heard this story, he knew he had to get involved. So in 1983, he bought 80% of her company. Not with a massive team of lawyers and a 1,000-page contract. Nope, with a handshake and a simple 2-page agreement. He wasn't just investing in a business, he was investing in her.
All right, that brings us to our fourth play, and this is where things get really dramatic. Greed, fear, and crisis. Remember that quote from the very beginning, "Be greedy when others are fearful"? Well, this is where that philosophy gets put to the ultimate test. We're talking about the 2008 financial crisis. The world economy is teetering on the edge of a cliff. Everyone is panicking. And Warren Buffett, he went shopping.
And to really understand the mood back then, you just have to look at this number, negative 57%. The S&P 500 lost more than half its value. The fear was everywhere. You could feel it. People were convinced the entire system was about to collapse. Retirement savings were just evaporating. This wasn't a dip. This was a full-blown, once-in-a-generation panic.
So what does Buffett do in the middle of all this chaos? While the world is selling everything that isn't nailed down, he goes on one of the most legendary buying sprees in history. I mean, look at this timeline. Just days after Lehman Brothers goes bankrupt, he's pumping $5 billion into Goldman Sachs. A month later, another $3 billion into GE. Then he's financing a deal for Wrigley and Mars for $6.5 billion. And it just keeps going. He wasn't just buying stocks. He was basically the lender of last resort for corporate America, stepping in with cash and confidence when absolutely no one else would.
Let's just zoom in on one of these deals, the Goldman Sachs one, because it's a total masterclass. See, he didn't just go buy their stock on the open market like you or I would. Oh no. First, he bought $5 billion of special preferred stock. This guaranteed him a 10% dividend every year. That's $500 million a year just for showing up. Then, on top of that, he got warrants, which basically gave him the option to buy their regular stock at a super cheap price down the road. The result of this incredible deal? A profit of more than $3 billion. He got paid a fortune while he waited and still had all the upside. Just brilliant.
So he's got this sprawling empire of candy companies, furniture stores, insurance giants, and investment banks. How in the world does he manage all of that from a tiny office with only 25 people? Well, that brings us to the final play in the playbook, the Empire of Trust. And honestly, this might be the most surprising part of the whole story, because Berkshire's management style is, well, it's the opposite of what you'd expect.
The whole method is just shockingly simple. Step 1, hire the best possible managers you can find. Step 2, get out of their way. That's pretty much it.
Give them total freedom. Let them run their companies as if they owned them. The only thing Buffett demands is rock-solid integrity. He has this famous line he tells his managers, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." That says it all.
And this isn't just some nice theory. Let's take a real-world example, Brooks Running Shoes. When Berkshire bought the company, the CEO, Jim Weber, was given the freedom to take a huge risk. He decided to cut more than half of their products and focus the entire company on one thing, high-performance running. And guess what? It worked, big time. The company's sales exploded, and Buffett was so impressed that he actually spun Brooks out as its own standalone company, with the CEO reporting directly to him. And this quote from that CEO, Jim Weber, just nails it. He says he's never felt more trust from someone he's worked for, but he's also never felt more responsibility. And that's the magic, right? By giving his managers that incredible trust, he gets this fierce sense of ownership and accountability back in return. It's a leadership style that the best people just flock to.
Okay, so let's wrap this all up. What is the Empire Builder's playbook? It's basically this. First, find yourself a massive, cheap source of cash, like insurance float. Second, use that cash to buy truly great companies with protective moats. Third, wait patiently for everyone else to panic and then be greedy. And finally, hire amazing people and trust them completely to do their jobs. That's the formula.
And that leaves us with one big final question. The playbook we've just walked through, it's all about stability, simplicity, and brands that last forever. But let's be real, we live in a world of insane technological disruption. So here's the question for you. Is this empire, built on these timeless ideas, actually built to last? Can it survive and thrive in a future that looks almost nothing like the past? That is something to think about.
So how does a company that's famous for being, well, old school, not just survive but thrive in a world that's all about tech? That's the big question we're going to dig into today. We're talking about Berkshire Hathaway and this absolutely pivotal decade from 2010 to 2020. This was a time of massive change where they made some of the biggest, boldest, and honestly most shocking bets of their entire history.
All right, so here's how we're going to break it all down. First up, we'll look at the new decade and the huge challenge they were facing. Then, we'll meet the guys who were basically the heirs apparent. After that, the really juicy part, the great tech pivot. We'll also cover how they stuck to their guns with some big bets on old principles. And of course, we've got to talk about the lessons they learned the hard way.
Okay, let's jump in our time machine. The year is 2010. The world's kind of shaking off the dust from the Great Recession. And what's everyone talking about? Tech. It's the new king. You've got Apple, Google, Amazon. They're rewriting the rules of the economy like every single day. But way out in Omaha, Nebraska, at Berkshire Hathaway headquarters, they're asking a totally different, much more fundamental question.
And this right here gets the absolute heart of the problem for Berkshire. For, 50 years? Warren Buffett's rule was dead simple. Invest in what you understand. You know, that's why he bought railroads, insurance companies, soda brands, stuff you could touch and feel. But by 2010, the entire world was being powered by things he openly said he didn't understand. We're talking cloud computing, social media, smartphones. This whole new universe of giant companies was exploding, and Berkshire, one of the biggest companies on the planet, was just watching from the sidelines.
Yeah, and look, this wasn't just some abstract business problem on a spreadsheet. It was a deeply human one. Think about it. At the start of the decade, Warren Buffett is 80 years old. His partner, the legendary Charlie Munger, is 86. So the question on everyone's mind, from Wall Street to Main Street, was, what's next? What happens to this empire when these two guys aren't around anymore? A succession plan wasn't just a nice to have. It was absolutely critical for the company's future.
So you've got this huge existential crisis on your hands. What's the solution? Well, in classic Buffett style, the answer was both incredibly simple and, frankly, brilliant. He decided to find the next generation of leadership himself. He needed two people who could not only carry on the legacy, but could also steer this massive ship into a completely new world. And boy, did the two guys he found change everything.
First up, meet Todd Combs. He was hired in 2010. And in so many ways, Combs was the perfect fit. Like he was grown in a lab to be a Buffett apprentice. He was crazy smart, sure, but it was more than that. He came from the exact same value investing program at Columbia that shaped Buffett himself years and years ago. Plus, he'd already proven he could do the job, running his own successful hedge fund. He spoke the language. He got the Berkshire way of thinking.
And then there was Ted Weschler. Now this guy, his track record was just insane. A Wharton grad, sure, but his hedge fund? It returned over 1,200% to his investors before he shut it down to come work for Berkshire. I mean, a 1,236% return. He was an absolute rock star in the finance world. But the craziest part of his story isn't even that number. It's how he got the job.
So how exactly do you get a job with Warren Buffett? Well, if you're Ted Weschler, you buy your way in. And I don't mean in some sketchy way. I mean he anonymously bid over $2.6 million at a charity auction just to have lunch with the guy. And he did it twice. Can you imagine? After that second lunch, Buffett was like, okay, yeah, I've found my guy.
But really, what was the secret sauce? What made these two guys the perfect choice? When someone asked Buffett, he gave the most classic Buffett answer ever. He said, "These were the only two guys we could find who read just as much as we did." And you gotta understand, in the Berkshire universe, that's not just a cute little compliment. It's everything. It means they shared the same DNA, this relentless curiosity that drives the whole company.
Okay, so now you've got Combs and Weschler on the team. The stage is set for what is basically a revolution inside Berkshire. These two new guys brought a totally fresh perspective, right? And they were willing to look at stuff that was always considered off-limits. And that led to the single biggest, most mind-blowing shift in the company's entire history, the Great Tech Pivot.
Just look at this trajectory. It really tells the story of how they learned to love tech. It starts kind of slow, a cautious first step with IBM back in 2011. But then, boom, 2016. That's when they take the real leap of faith with Apple, and that one bet would change everything for Berkshire. And after that, the floodgates just opened. They invested in Amazon, and then did something truly shocking. They bought into the Snowflake IPO.
But listen, it wasn't a straight line to success. Not at all. That first big bet on IBM, a nearly $11 billion investment, it ended up being a rare, very public mistake for Buffett. And he ended up selling it at a loss. He just misjudged it. But then came Apple. And this is where the story gets incredible. See, Buffett finally started to see Apple not as this crazy tech company, but as a consumer brand. A company with a powerful, unbreakable connection to its customers, a moat, in his language, that he could finally get his head around. And that single insight led to one of the greatest investments of all time.
I mean, just look at this chart. The numbers are staggering. It's almost hard to believe. What started as a pretty small $1 billion investment in 2016 grew into a stake worth over $157 billion just 5 years later. That's not a typo. And this one decision, which, by the way, was heavily influenced by his new guys, Combs and Weschler, it didn't just make them a boatload of money. It totally rewired the DNA of the entire company for the modern era.
You know what the biggest sign of this transformation was, though? It was Buffett himself. For years, he'd publicly praised Jeff Bezos and Amazon, but he never bought the stock. He just couldn't bring himself to do it. So when one of his new guys, one of the Todds, finally started buying it for Berkshire, Buffett's reaction was amazing. Just pure humility. He said, "I've been an idiot for not buying." I mean, for a guy whose entire reputation is built on being right, that's a pretty incredible thing to admit. And then came the moment that really showed the old Berkshire was gone. In 2020, they did something that, just a few years before, would have been completely unthinkable. They invested in a super hot tech IPO before it even started trading. The company was called Snowflake, and on the very first day, Berkshire made a paper profit of more than $800 million. Let me tell you, that is a long, long way from buying railroad companies.
Now, it's really important to remember something. Don't let all this talk about tech fool you into thinking they abandoned their roots. Not even close. While they were definitely embracing this new world, they were also doubling down on the old school stuff. The tech pivot was a huge deal for sure, but they were running a two-track strategy, sticking to the core principles that made them who they are.
All right, let's take a look at a classic old-school Berkshire deal from this time, the acquisition of Lubrizol in 2011. This was a nearly $10 billion deal, and it was pure textbook Buffett. It checked all his boxes. Great return on equity, a massive competitive moat with over 1,600 patents, the power to set its own prices, and great stable management. This was, Buffett ball at its finest.
And it wasn't just what they bought, it was how they bought it. The Duracell deal in 2014 is just a brilliant example of their financial creativity. Okay, so get this. Instead of just buying the company with cash, they already owned a bunch of Procter & Gamble stock. So they basically traded that stock directly for the Duracell company, which P&G owned. The result? They got an iconic brand without having to pay a dime in taxes on the deal. It was just so smart.
And make no mistake, when they went for these traditional investments, they went big. In 2016, get this, the very same year they started buying Apple, they made their largest acquisition ever. They spent over $32 billion on a company called Precision Castparts, which makes complex parts for airplanes. It was a massive statement that, yeah, even in the age of tech, they were still all about the bricks and mortar of the American economy.
But of course, it wasn't all sunshine and rainbows. This decade of huge change also came with a lot of pain. For every massive home run like Apple, there was a pretty ugly strikeout. And if you really want to understand the story of this decade, you absolutely have to look at the big mistakes and the tough lessons they learned along the way.
Okay, so there is almost no industry that Warren Buffett has trash-talked more over the years than airlines. He famously called the industry a death trap for investors. He even joked that capitalists should have just shot Orville Wright down at Kitty Hawk to save everyone the trouble. He hated it. So you can imagine everyone's surprise when, in the late 2010s, Berkshire started pouring billions of dollars into 4 major airlines. It made no sense.
Well, that airline bet, it turned out to be a total disaster. When the pandemic hit in 2020, the whole industry just collapsed, and Berkshire had to sell everything for a huge loss. But that wasn't the only screw-up. There was the Kraft Heinz deal, where Buffett himself later admitted they paid way too much. And then there was this ambitious healthcare project called Haven. All of these were just painful reminders that even the Oracle of Omaha gets it wrong sometimes, and gets it wrong big.
You know, the idea behind Haven Healthcare was actually pretty great. Buffett has this incredible way of describing things, and he called the rising cost of healthcare a tapeworm on the American economy. This venture was supposed to solve that. But even with the power of Berkshire, Amazon, and JP Morgan behind it, the American healthcare system just proved to be too big, too complex, and too powerful to fix. The whole thing was shut down after just 3 years.
So, when you look back at this absolutely wild decade of change at Berkshire Hathaway, it leaves you with a really interesting question. What was Warren Buffett's single greatest investment of the decade? Was it the incredible bet on Apple that made them hundreds of billions of dollars and changed the company forever? Or was it the people he hired, the 2 guys who came in and helped him and his entire company finally see what the future could look like?
When you think about investing, you probably think of Warren Buffett, right? The guy is basically synonymous with success. But what if I told you the real key to his genius isn't in his wins, but in his massive failures? Today, we're not just looking at Buffett's blunders. We're going to uncover how his absolute costliest mistakes forged the very principles that made him a legend. And let's start with a quote from the man himself. You see, Buffett believes his biggest errors aren't the bad stocks he actually bought, but the truly world-changing companies he didn't. These are the so-called ghosts in his portfolio, the incredible opportunities he just let slip through his fingers. He uses this great analogy all the time. He compares investing to baseball, talking about Ted Williams, the last player to bat over .400. Now, what's just fascinating is that even at that historic peak of success, Williams failed to get a hit almost 60% of the time. It's such a powerful reminder that striking out is just part of the game. So with that in mind, let's take a look at some of Buffett's biggest swings and misses. Okay, so here's our game plan. We're going to start with his earliest lessons in patience. Then we'll unpack this single emotional mistake that might have cost him an estimated $200 billion. We'll explore his dangerous attraction to bad bargains and the tech revolutions he totally missed, all leading up to the ultimate framework he built directly from the ashes of these failures. All right, first up, the early lessons. Now, these youthful mistakes weren't his costliest in terms of dollars, but they were maybe his most important. They literally shaped his entire approach to investing for the next, 80 years. What's really interesting about this timeline is that each of these early stumbles planted a seed for his entire philosophy. In 42, an impatient sale taught him about missed opportunity. A decade later, a failed gas station venture taught him about the power of branding. And his early investments in giants like GEICO and American Express, they would teach him the same painful lesson over and over. Whatever you do, don't sell your winners. Picture this, Warren Buffett, just 11 years old. He buys his very first stock, 3 shares for himself, 3 for his sister. And when the price hits $40, he sells. He locked in a small but, very satisfying profit. He was officially in the game. And then the agony set in. He had to sit there and watch as that same stock soared to $200 a share. This was his first and probably most brutal lesson in the sheer power of patience. He learned that letting your winners run is just as important as picking them in the first place. And that $160 per share that he missed out on? Well, that is the perfect definition of something called opportunity cost. See, it's not just about losing money, it's about the incredible gains you give up. And he'd make this mistake again, selling future giants like GEICO and American Express way too early, costing himself billions, simply because he got a little impatient. Okay, now let's get to the big one. The mistake so massive, so formative, that he literally named his multi-hundred-billion-dollar empire after it, just as a constant reminder of what not to do. I mean, just let that number sink in for a second. $200 billion. That's more than the GDP of a lot of countries. What kind of incredibly complex financial miscalculation could possibly have a price tag that high? Well, the answer is kind of shocking in how simple it is. It wasn't about the numbers at all. See, back in the 1960s, the head of this failing textile mill, Berkshire Hathaway, tried to cheat him on a stock deal by 1/8 of a point. Buffett got so angry, so full of pique, he went out and bought control of the entire company just so he could fire the guy. It was a move made purely out of emotion. And boy, did he learn a lesson. He spent the next 20 years pouring money into that dying textile business. And this quote right here sums up exactly what happened. He learned that even a brilliant manager can't save a fundamentally broken industry. The bad business will win every single time. He figures if you just put that money into a simple insurance company instead, his firm would be worth an extra $200 billion today. So this leads us to a mistake Buffett would make over and over and over again, the seduction of the bargain. He was trained to look for what he called cigar butt businesses, companies that were discarded but had one last free puff of profit left in them. The problem? Well, that one puff often came with a really terrible aftertaste. This quote, this became the absolute central pillar of his modern philosophy, and it really represents a massive turning point. It was actually his partner, Charlie Munger, who just hammered this into him. It's way, way better to pay a fair price for a truly great business you can hold forever than it is to get a great price for a mediocre business that's just going to give you headaches. And you can see this painful pattern play out right here. In 1966, he bought a cheap department store and learned just how brutal retail is. Then, in 1975, unbelievably, he bought another failing textile mill. But the absolute worst was Dexter Shoe in 93. He paid for it with Berkshire stock, thinking its competitive advantage was solid. It wasn't. The business went to zero, and the stock he used to buy it? Today it'd be worth around $9 billion. Ouch. And this weakness for a good deal, it extended to entire industries. He knew for a fact that airlines had terrible economics, huge costs, brutal competition, but he just couldn't help himself. He used to joke that he needed an 800 number to call whenever he felt the urge to buy an airline stock, calling himself a recovering aeroholic. So now let's talk about those mistakes of omission, the ones that Buffett himself says are the absolute most painful. These are the titans of industry he just watched from the sidelines, all because he felt they were outside his famous circle of competence. His number one rule is pretty simple. Never invest in a business you don't fully understand. And while that's a great rule that protected him from a lot of bad ideas, man, did it cost him. He was good friends with Bill Gates, but passed on Microsoft. He used Google's advertising for his own companies, but passed on the stock. He admired Jeff Bezos for decades, but didn't actually buy Amazon until 2019, literally calling himself an idiot for waiting so long. It wasn't just tech he misjudged either. It was also major shifts in how we, eat. His huge investment in Kraft Heinz was a bet on the timeless power of classic brands. But he completely failed to see the massive shift toward private label brands like Kirkland, and this growing hunger for fresh, organic foods that you find on the edges of the grocery store. And that miscalculation, well, it had a very, very real price tag. The changing tastes of shoppers led to a staggering $15.4 billion write-down. And Buffett was totally upfront about it, openly admitting he had simply overpaid for Kraft because he failed to see that the world had changed around his iconic brands. So, okay, we've walked through decades of blunders. What is the grand lesson here? What's the ultimate framework that was born from all these billion-dollar mistakes? Well, it turns out to be both really profound and surprisingly simple. And this is it. This is the heart of the matter, right here in his own words. He's saying that successful investing isn't about being a super genius or getting secret tips. It's about building a rational system for making decisions. And this is the crucial part, having the emotional discipline to actually stick to that system when fear or greed or even anger try to take over.
And every single mistake we've talked about today reinforces these core principles. The Berkshire Hathaway purchase taught him to control his emotions. The Dexter shoe disaster forced him to refine his intellectual framework. His tech omissions taught him the importance of lifelong learning. And a costly energy deal he made without talking to Charlie Munger, that taught him the immense value of having a trusted partner who isn't afraid to tell you you're wrong. In the end, Buffett's long list of errors isn't really a chronicle of failure. It's more like a blueprint for learning. It proves that while making mistakes is inevitable, actually growing from them is a choice. It shows that our biggest blunders can become our greatest assets. Which really just leaves one question for you to think about. What's the most valuable lesson a mistake has ever taught you?
Okay, when I say the name Warren Buffett, what pops into your head? The stock market, right? Berkshire Hathaway, unimaginable wealth. He's the Oracle of Omaha, a total financial legend. But today, we're going to pull back the curtain. We're looking past the investor to really get to know the man. We're going to explore the deeply personal and honestly often surprising principles that have guided his life. And you'll see, they have way more to do with happiness and character than they ever did with money. All right, let's dive in.
And we're going to start right here. This might just be the most shocking thing you'll ever hear from a billionaire. Forget about profits. Forget about compound interest. For Buffett, the ultimate measure of a good life is love. This one idea is basically the key to understanding his entire philosophy, and it's the thread that's going to connect everything we talk about today.
So here's the game plan. First, we'll look at what he calls the real bottom line. Then we'll see why he's convinced money isn't happiness, and you'll see it in how he lives. We'll take a trip to the Woodstock for capitalists. You're going to love that. Then we'll get into a really critical lesson called the 2 scorecard, see his incredible philanthropic revolution, and we'll wrap it all up with Buffett's own recipe for a happy life.
Okay, let's jump right into our first section, the real bottom line. And no, we're not talking about Berkshire's earnings report here. We're talking about the absolute foundation of a happy life, according to the man himself.
Here's the thing you have to understand. Even with enough money to buy literally anything, Buffett is crystal clear that the real engine of his joy is something money can't buy. It's all about his relationships, his family, his friends, and the simple fact that he gets to, in his words, tap dance to work every day. He just loves what he does. He has this famous saying that his wealth can't buy him the 2 most important things, more time and more love. Everything else, it's just noise.
And that idea leads us perfectly into section 2. Money isn't happiness. This is where you really see the mind-blowing gap between the size of his fortune and the simplicity of his life. And trust me, it's not some kind of act, it's his core belief system in action.
You know what's so fascinating about this is that it's like his quiet little rebellion against the whole culture of corporate excess. He really seems to have a genuine disdain for the typical CEO playbook. You know, the private jets, the fancy club memberships, the insane pay packages. He just sees it all as wasteful and totally disconnected from how a company is actually doing.
Now get this, his salary has been locked at $100,000 a year since 1980. Think about that. For the CEO of one of the biggest companies in the world, that's basically unheard of. His logic? It's simple. He says it's more than enough to live comfortably, and he thinks his financial success should be tied to the success of his shareholders, not some giant salary. He's never sold a single share of Berkshire stock for his own expenses, not one.
And this way of thinking, it just bleeds into his personal life. He still lives in the same modest 5-bedroom house in Omaha that he bought way back in 1957. People ask him why he doesn't have a huge mansion or a yacht. His answer is always the same. My life is the happiest I could have. More stuff would just complicate it. It's a very deliberate choice to keep things simple in a world that's always yelling at you to get more.
And this quote just nails his philosophy. This belief that if you just double your income or your net worth, you'll suddenly unlock some new level of happiness. He thinks that's a dangerous trap. He argues that's the kind of thinking that leads people to start cutting corners, to take stupid risks, and to compromise their integrity, which is the one thing you can never, ever buy back.
Okay, let's switch gears and head to section 3. We're going to see how this whole unique philosophy plays out at the strangest corporate event on earth, the annual shareholder meeting he calls Woodstock for Capitalists.
What's amazing is this whole thing started with like a dozen people in the company cafeteria. Now, it's a global phenomenon. Every single spring, over 40,000 people pack their bags and head to Omaha, Nebraska. They come from everywhere, from all over the world, basically turning the city into the center of the financial universe for a weekend. It's a huge testament to the community he's built.
And let me tell you, this is not some stuffy, boring meeting. It's a full-on carnival celebrating everything Berkshire Hathaway. They have a newspaper throwing contest where people try to beat Buffett's record from when he was a kid. He and his late partner, Charlie Munger, would famously just sit on stage for hours, answering any question you could think of while snacking on See's candies and drinking Coca-Cola. It's fun, it's open, and it really drives home the idea that his shareholders are his partners.
So, where did this all come from? What's the source code for this worldview? Well, that brings us to Section 4, the 2 scorecards. This is probably the single most important lesson Buffett ever learned, and it came straight from his father, Howard Buffett.
So his dad taught him that everyone has 2 scorecards to measure their life by. There's the outer scorecard, that's how the world sees you, your job title, how much money you have, the awards on your wall. But then there's the inner scorecard, and that one is your own measure of your character, your integrity, your honesty, your kindness. And his father was very clear. At the end of the day, the only one that really truly matters is that inner scorecard.
Okay, so how do you stay true to that inner scorecard? Buffett has this beautifully simple, super powerful ethical test he gives to all his managers. Before you do anything, ask yourself this: would you be okay with that action being reported in detail on the front page of your local newspaper for all your friends, family, and neighbors to read? It's the ultimate gut check for integrity.
This philosophy even guides how he thinks about parenting. He says that leaving your kids a giant inheritance is like giving them a lifetime supply of food stamps. It's the most antisocial thing a parent can do. He actually gave his son Peter his inheritance early on. It wasn't enough to just sit around and do nothing, but it was enough to buy him time to chase his real passion, which was music. Peter says it was the greatest gift he ever got because it forced him to find his own way and build his own life.
So what about all that money he's not spending on himself or leaving to his kids? Well, that brings us to Section 5, a philanthropic revolution. See, Buffett doesn't really see his fortune as his. He calls his stock certificates claim checks on society, and he believes his job is just to figure out how to give those resources back to the world in the smartest way possible.
And the scale of his giving is, well, it's just breathtaking. By 2022, he had already given away more than $46 billion. But that's just getting started. He has pledged to give away more than 99% of his entire fortune, either during his life or when he passes. It's one of the largest philanthropic promises in human history.
So where does it all go? Well, true to form, he delegates. The biggest chunk goes to the Bill and Melinda Gates Foundation, because he thinks they're the best in the world at tackling global health. He also funds foundations run by each of his 3 kids, empowering them to go after their own passions, whether that's sustainable farming or protecting the rights of women and girls. He's investing in people he trusts to get the job done.
But he didn't want to just give away his own money. He wanted to change the entire culture of giving among the ultra-wealthy. So back in 2010, he and the Gateses created the Giving Pledge. It's a public promise by the world's richest people to give the majority of their wealth to charity. It's become this huge global movement, with over 230 billionaires who've now pledged a combined, get this, over $600 billion to help solve the world's biggest problems.
Which brings all these different ideas together into our final section. We're going to boil it all down to Buffett's recipe for life, some real, actionable advice that works for anyone, no matter how much money you have.
Remember that opening quote about being lovable? Well, this is basically the instruction manual. It's not rocket science, but it's really deep. It's all about leading with kindness and having integrity. It's about listening more than you talk. It's about being grateful, not taking yourself so seriously, and actually finding joy in what you do every day. Because that's the kind of energy that just makes people want to be around you.
And at the end of it all, he says this is it. This is the single most important decision you will ever make. It's more important than any stock you'll ever pick or any career path you choose. Who you pick as your partner in life, that's the whole ballgame. It's his ultimate piece of advice, and it brings everything right back to where we started, the importance of human connection.
So I'll leave you with this question to think about. Warren Buffett has spent his entire life being guided by the things on his inner scorecard, that private measure of his own character. In a world that's so obsessed with how things look on the outside, that's a pretty powerful challenge. So, what's on your inner scorecard?
Welcome to The Explainer. You know, getting even a moment of Warren Buffett's time is, well, it's pretty much impossible. So how did one university professor manage to get 3 separate visits for his students? This is a really incredible story about what it takes to get the attention of the world's most successful people. It's all about persistence, creativity, and most importantly, creating real value. And look, Buffett absolutely lives by this philosophy. His schedule is like a fortress. and it's guarded by one simple word: no. He gets that his most valuable asset isn't his money, it's his time. And that means he turns down thousands and thousands of requests for meetings, for interviews, you name it, making him one of the most inaccessible people on the entire planet.
Right? That's the billion-dollar question. And what we're going to do here is follow the journey of someone who didn't just get lucky once, he actually found a kind of formula, a way to crack the code and earn that yes from someone with one of the most protected calendars in the world.
So our story kicks off with a simple, but let's be honest, pretty audacious goal. A professor just wanted to give his students the chance to learn from the absolute best. But as you can probably guess, he hit a massive wall right away. Yep, exactly. He wasn't just rejected. He was told the line was so long he couldn't even get on the waiting list. For most people, that's it. Game over. A polite no from Buffett's office is pretty much final. But for this professor, it was just the start. This is where the professor had this fundamental realization. When you just ask for something, even something great like knowledge, you're just another voice in a massive crowd. So he decided to flip the whole equation on its head. Instead of asking, he was going to offer something valuable first. And that brings us to his new strategy. This wasn't about just asking again nicely. No, this was about earning the right to ask through some serious academic dedication and just pure persistence. Okay, so this was the game plan, and it was brilliant. First, he spent over a year researching and writing a serious, in-depth academic paper on how Buffett masterfully navigated the 2008 financial crisis. Then, he got it published in a respected journal, which gave it real credibility. And only after all that work did he send a copy to Buffett. He was no longer just a fan asking for a favor. He was a peer, offering a really valuable, unique analysis of Buffett's own work. And you know what? It worked. It worked brilliantly. In just 10 days, a letter showed up, and it was directly from Buffett himself. His school, the University of Akron, got moved to the very top of that ridiculously long list. He provided value, and Buffett recognized it instantly. So during that first visit, the students really got to hear Buffett's wisdom firsthand. He broke down his whole investment philosophy with this simple analogy. He said he approaches it like recruiting for a basketball team. He's not looking for average players. He's looking for the rare seven-footers, those companies with unique, almost unfair, and lasting strengths. And that is what he means by a seven-footer. It's what he famously calls a company's moat. A moat is just a unique advantage a business has that's super difficult for any competitor to get over. Think about Coca-Cola's brand, right? Or Wrigley's dominance in the gum aisle. Those are moats that protect their business castles. He also talked about the incredible power of focus. He told the students how he used to just pore over these 1,000-page Moody's investment manuals, page by page, just searching for those few golden opportunities. And his point was so powerful. You don't get rich from 1,000 okay ideas. You get rich by having the discipline to find and really commit to a handful of truly brilliant ones. And the day was just filled with these little moments that showed you who he really was. There was his old Cadillac with the license plate Thrifty, his almost childlike excitement over this gigantic root beer float, and what's maybe most impressive, on the very same day a huge acquisition was announced, he completely ignored the media frenzy to give his full, undivided attention to the students. Okay, so getting invited once, that was a monumental achievement. But getting invited back, well, that required a whole new level of thinking. The professor's next move wasn't just about persistence anymore. It was about being remarkably creative. So, 2 years later, the professor is at a new school, Gonzaga University. He knows he can't just send another case study. So he turns the challenge over to his students with this brilliant assignment. Come up with a new product that you think Warren Buffett would actually like. The first idea was just fantastic. A custom pinball machine. Now, why a pinball machine? Because, and this is so smart, the students did their homework. They knew that Buffett had owned a pinball machine company way back in high school. This wasn't just a random gimmick. It was a really personal and clever nod to his own entrepreneurial past. The second project was just as creative, a parody of the classic board game Clue. They called it Buffett in the Boardroom with a Bat, and they cast the investor himself as a character. It was playful, it was smart, and it showed a real sense of humor and originality. And for the final pitch, they went straight to the heart.
The students made a video that showcased what made their university special, and they focused on the very same entrepreneurial values that Buffett is known for. It was their way of saying, hey, this is who we are, and we share your mindset. And once again, this value-first approach just worked. Buffett's office got back to them in less than a week. He was so charmed by the creativity of all three of these ideas that he extended a second invitation to come to Omaha. They had earned their audience all over again.
So the journey wraps up with a third and final visit. And this is where you really see how those first efforts just snowballed into this lasting legacy, not just for the professor and his students, but for students all around the world. You can really see the whole evolution right here. That first visit, born from persistence, was part of a pretty small group. The second, which was all about creativity, was a special reward. But by the final visit in 2018, which was also earned through more published work, the event had become this massive international affair. By this point, the Q&A session was way too big for Berkshire Hathaway's offices. They had to hold it in a huge hotel ballroom to fit nearly 200 students from 9 different universities, including one that came all the way from Peru. And here's Buffett, at 88 years old, still totally committed to mentoring the next generation. But here's the thing that really stands out. When the professor looked back, he realized that what his students remembered most, it wasn't the stock tips or the business strategies. Their biggest takeaway was Buffett's definition of a truly successful life. And it was this: find your passion, live with integrity, treat everyone with respect, and surround yourself with people who love you unconditionally. So, when you really boil it all down, this story isn't just about meeting a famous investor. It's a masterclass in how to go after any goal. Don't just ask for an opportunity, earn it. Create something of value, whether it's through persistence or creativity, and you really can open doors that seem permanently shut. So the question to leave you with is, what value will you create?
Welcome to The Explainer. So today, we're going to peel back the layers on one of the world's most legendary companies. We're talking about Berkshire Hathaway and what its future looks like.
You know, this one sentence, it pretty much sums up the entire Warren Buffett playbook that built an empire. It's all about that long-term, steady value investing. I mean, think about Coca-Cola. He's held that stock for more than 30 years. It's the perfect example of his whole philosophy. Find a great company and just hold on. That's been the Berkshire way for what, over 50 years now?
And you know what? This whole strategy of investing in what you know is what made him a legend, especially when that dot-com bubble burst and, well, he basically got the last laugh. But, and this is a big but, for years, this same strategy brought a ton of criticism. People were calling Berkshire an old economy dinosaur, you know, this relic that was totally missing out on the insane growth of the digital age.
So the big question is, how did this old-school giant actually get ready for a world it seemed to be, frankly, ignoring? Well, that's what we're going to break down. We're going to walk through this whole transformation in 5 key parts. We'll start with their classic playbook and take it all the way to what happens after the oracle.
All right, let's jump right in. To really get what's happening now, we have to start with the foundation. You know, what made Berkshire so successful in the first place?
Okay, so for decades, if you looked at Berkshire's portfolio, it was full of names you'd totally recognize from the physical world. We're talking big traditional banks like Wells Fargo, classic consumer goods, insurance giants, the whole 9 yards. But wow, has that changed? I mean, it's changed dramatically. The new portfolio, it's all about a massive pivot towards those cutting-edge tech companies that are literally building our future. Think data, cloud computing, e-commerce, a completely different world.
So let's dig into that pivot because it's honestly one of the biggest and weirdly one of the most underreported stories in modern investing. We're talking about a shift that completely turns a 50-year tradition at Berkshire on its head.
So, has Berkshire really ignored tech all these years? I mean, for decades, pretty much everyone would have said absolutely yes. But what do the numbers actually say? Well, the answer, it's probably not what you think.
Okay, get ready for this because the sheer scale of this change is just wild. A single tech company, Apple, now makes up a whopping 45% of Berkshire's entire public stock portfolio. 45%. This isn't them just, dipping a toe in the water. This is a full-on cannonball.
And that really shows you the whole picture, the total transformation, because it's not just Apple. Nope. When you start adding in their other tech-related holdings, we're talking giants like Amazon and the cloud data company Snowflake, that number jumps to around half of all their investments. So think about that. Berkshire Hathaway, the old economy icon, is now, quietly, a tech-heavy fund. That's a universe away from where they started.
So here's the key takeaway. This massive shift didn't just happen by accident. Oh no, it was completely intentional, driven by some new faces. It's kind of like how Charlie Munger broadened Buffett's thinking all those years ago. Now you've got Todd Combs and Ted Weschler. These guys are known for being super sharp on tech and finance, and they were brought in specifically to grab the baton and steer this massive ship into the future.
And this big pivot into tech, it also cracked open the door to one of the most controversial, most disruptive sectors out there right now, fintech. And this is where things get really interesting, because it's a space where Berkshire's old guard and its new guard seem to have, let's just say, very different opinions. And they're not quiet about it either.
So what even is fintech? Well, simply put, it's everywhere. If you've ever used your phone to check your bank account, or if you've ever traded a stock online, guess what? You've used fintech. It's basically the engine that makes modern finance run.
Now, Berkshire's top brass, especially the famously blunt Charlie Munger, have been, well, hostile to crypto is putting it mildly. Buffett himself once called Bitcoin rat poison squared. I mean, their hatred for this whole sector has been very, very public. And yet, and this is where it gets fascinating, Berkshire has poured billions into the very same ecosystem they trash talk. They have a huge stake in Nubank, which is a digital bank in Brazil that literally lets you do crypto transactions. They've also invested in payment companies like StoneCo and Paytm. So what is going on here? It really seems like while Buffett and Munger are on stage calling crypto rot poison, their investment managers are in the back room quietly buying up all the plumbing for the future of digital money.
But you know, this whole shift, it isn't just happening with private companies. It's happening at the government level too, with the rise of official government-backed digital currencies. And that could be an even bigger threat to Berkshire's old way of doing things.
We're talking about something called a central bank digital currency, or CBDC. And really, it's just a digital version of a country's cash. So think of a digital dollar, or like in China, a digital yuan. The key difference here? It is not decentralized like Bitcoin. No, this is controlled 100% by the government.
And in this new race, China is way, way ahead. I mean, their digital yuan is already out there and being used. This gives their government incredible control, and it's a serious tool they can use to challenge the US dollar spot at the top. The US, on the other hand, well, we're moving a lot more slowly with something called Project Hamilton, which is really just exploring all the risks and, the major privacy issues involved. So, why should Berkshire care about any of this? Well, here's why. A full-blown US digital dollar could mean you and I could bank directly with the Federal Reserve. And that could completely cut out the middleman, the commercial banks that have always been the gatekeepers of our money. For Berkshire's huge investments in traditional finance, this is a massive risk. It's like they own all the toll bridges, and suddenly the government builds a free superhighway right next to them. And this probably helps explain why Buffett recently dumped his huge stakes in companies like Visa, MasterCard, and Wells Fargo.
So you've got this pivot to tech, this kind of weird embrace of fintech, and this looming threat of digital currencies. All of these big changes lead to the one ultimate question. What on earth happens to this totally transformed company when its legendary founder isn't there to lead it anymore?
Well, Buffett has been thinking about this for a long time. He's very carefully laid out a succession plan, basically splitting his 3 big jobs among a new team. His son, Howard Buffett, is set to become the non-executive chairman. His job is to protect the company culture. Then you have Greg Abel, who runs all the huge non-insurance businesses. He's going to be the new CEO. Munger actually kind of let that slip at the 2021 shareholder meeting. And finally, the 2 guys who engineered this whole tech pivot, Todd Combs and Ted Weschler, they're officially taking the reins as the chief investment officers. So all the pieces are in place. The portfolio has been totally retooled for digital world, and the next generation of leaders is ready to go. But it leaves us with this one final, massive question about one of the greatest corporate success stories in history. The company is ready for the future, but can the magic, the intuition, the essence of Buffett and Munger ever really be replaced? I guess only time will tell if the legend can actually live on without its oracles.